mutual fund is simply a big basket where lots of people or investors put their money. Think like you don't have enough money to buy a good stock because its price is too high, and neither you know which one is good stock nor proper knowledge. If you invest in the wrong stock, you will lose all of your money, but you wanted to grow your money as well. What is the solution? The best solution is mutual funds. Mutual fund is like a big basket where you and thousands of investors like you put theirs money in mutual fund. And the mutual funds is managed by professional, experienced, and experts of team. They take the collected money and invest it in different things like stocks, bonds, gold, or other assets to help it grow over time. Because your money is combined with many others, you get the benefit of diversification means your risk is spread out, expert management, and the chance to earn better returns even if you're not an expert in investing yourself. Basically, there are three types of mutual funds. First is equity funds, second is debt funds, and third is hybrid funds. First, we talk about equity mutual funds. In the equity fund, your money invested in the stock market. Expected return around 10 to 15% per year. First funds based on company's size. First is small cap fund. Invest in smaller companies. Company value between $250 million to $2 billion. Second, mid cap fund. Invest in medium-sized companies. Company value $2 billion to $10 billion. Third, large cap fund. Invest in large, well-established companies. Company value $10 billion or greater. Second, multi-cap fund. Invest in a mix of large, mid, and small cap stocks. Means your money invest into small cap, mid cap, large cap together. Third, flexi cap funds. Invest in companies of any size fund manager decides based on market condition. For example, the small cap fund doesn't perform well. Then the experts pick the another fund, like large cap fund, as per market condition. For example, it could be mixture of small cap or large cap fund, or it could be mixture of mid cap or small cap funds. Fourth, sectoral or thematic funds. Invest in one specific sector or theme like IT sector, banking sector, pharma sector, EV sector, etc. Fifth index fund, basically based on index like NSE means Nifty 50, and BSE means Sensex. Sixth ELSS fund, also known as tax saving funds, help you to save tax under Section 80C. Mainly in this fund, you can save tax legally. Second, debt funds or fixed income funds. These funds invest in fixed income instruments like government bonds, corporate bonds, and treasury bills. Mainly, you invest in government bonds. These are three types. First is liquid funds, second is gilt funds, and third is corporate bond. Liquid funds invest in very short-term, up to 91 days debt instruments. They are low risk and highly liquid, making them an alternative to a savings account, with the 4 to 6% return. Gilt funds invest only in government securities, making them very safe from default risk, with the 5 to 7% return. Corporate bond funds invest primarily in debt issued by companies, with the 6 to 9% return. Third, hybrid funds or balanced funds. These funds invest in a mix of both equity and debt fund. In this fund, your money invested into equity fund and debt fund at once. They aim to provide a balance between growth from equities and stability from debt. Mainly, these are two types. First is aggressive hybrid funds, and second is conservative hybrid funds. Aggressive hybrid funds invest a larger portion, 65 to 80%, in equities and the rest in debt. Conservative hybrid funds invest a larger portion, 75 to 90%, in debt and the rest in equities.